Sarah and Daniel are twins. Same birthday, same parents, same upbringing. In January 2015, their grandfather passes away and leaves them each exactly $50,000. Same dollar amount, same day, same bank transfer hitting their accounts. They both think they're making the responsible choice. One of them is about to be wrong in a way that will haunt every Thanksgiving dinner for the next decade. Let's keep this fair. Sarah does what everyone tells you to do with inherited money. She doesn't touch it. She parks the full $50,000 in a high-yield savings account earning about 1.5% a year, the going rate back in 2015. Her financial advisor calls it the smart, boring move. She calls it peace of mind. Daniel does something completely different. He'd been reading about this weird internet currency called Bitcoin, trading around $250 a coin that January. Against the advice of literally everyone in his life, he puts the entire $50,000 in. That buys him roughly 200 Bitcoin. His mom tells him he's throwing his inheritance away on a monopoly money. His dad won't even discuss it at dinner. Sarah just shakes her head. On day one, Sarah has a number in a bank app that never moves and never scares her. Daniel has a number that swings 10% before lunch. It's not close in terms of how it feels. Sarah sleeps fine. Daniel checks his phone 4 times a day, watching his inheritance jump around like it's got a heartbeat of its own. By the end of 2015, Sarah's account has grown to about $50,750. Barely worth mentioning. Daniel's Bitcoin has climbed to around $430 a coin. His $50,000 is now worth roughly $86,000. He tells his family at Christmas. Sarah's dad calls it beginner's luck and reminds everyone that gambling isn't investing. Daniel doesn't push back. Even he isn't sure yet if this is real. Here's where most people assume the story just goes up and to the right from here. It doesn't. In 2017, Bitcoin goes on an absolute tear. By December, it's trading near $14,000 a coin. Daniel's 200 Bitcoin, the same 200 he bought for $250 each, is now worth roughly $2.8 million. $2.8 million from a $50,000 inheritance. His family stops calling it gambling. His dad asks him for advice. Then 2018 happens. Bitcoin crashes. Hard. By December 2018, it's sitting around $3,700 a coin, down more than 80% from its high. Daniel's $2.8 million portfolio is now worth about $740,000. He watched over $2 million evaporate in 12 months. His dad brings it up at dinner again, this time not asking for advice. See? Told you. Daniel doesn't say much. Even at $740,000, he's still sitting on more than 14 times what Sarah has. But it doesn't feel like winning. It feels like watching money disappear in real time, and that's a feeling numbers on a spreadsheet don't capture. This is the part every Bitcoin story skips. The gains are real, but so is the stomach-churning volatility that comes with them. Sarah, meanwhile, is still earning her 1.5%. Her account crosses $54,000. She didn't gain $2 million. She also didn't lose $2 million. Her line on the chart is flat, boring, and completely predictable. There is real value in that, and we'll come back to it. Let's run the scoreboard through 2020. Bitcoin climbs back, closing the year near $29,000. Daniel's 200 coins are now worth approximately $5.8 million. Sarah's savings account, even with a small rate bump, sits around $56,000. The gap between them is no longer measured in thousands. It's measured in millions. 2021 brings the euphoria. Bitcoin peaks near $69,000 in November. For a brief window, Daniel's original $50,000 inheritance is worth close to $13.8 million. $13.8 million. He doesn't cash out. He doesn't need to. He's not thinking about spending it. He's thinking about what happens if it goes to zero, which, statistically, plenty of people were telling him it eventually would. Then 2022 arrives and takes a hammer to the crypto market. Bitcoin falls to around $16,500 by year's end. Daniel's peak of $13.8 million shrinks down to roughly $3.3 million. He lost more money on paper in 12 months than most people earn across an entire career. Twice now, he's watched his net worth swing by 7 figures in a single year. That's not a hypothetical stress test. That's Tuesday, for someone holding an asset this volatile. Sarah's savings account crosses $58,000. Interest rates finally rose enough by 2023 to give her account a real boost. She's earned more in the last 2 years than in the previous 7 combined. It's still nothing compared to Daniel's swings, but it's steady, and steady has value that doesn't show up on a chart. Between 2015 and today, Daniel watched his net worth fall by more than 80% not once, but twice. Most people cannot survive that emotionally. The data backs this up. Study after study on retail crypto investors shows the overwhelming majority sell during the crashes, not the recoveries. They buy the top out of excitement and sell the bottom out of fear. Daniel's $22 million outcome required him to do the single hardest thing in investing, absolutely nothing, while watching millions of dollars disappear and reappear in front of him. There's also survivorship bias baked into this entire story. For every Daniel who put his inheritance into Bitcoin in January 2015 and held for a decade, there were people who did the exact same thing with other coins that went to zero. Daniel picked the one that worked. That's not a strategy. It's picking a specific historical outcome and working backward from it. Nobody in 2015 knew Bitcoin would still exist in 2026, let alone trade above $100,000. Daniel didn't have a crystal ball. He had a gut feeling and an unusually high tolerance for risk, and this time, it paid off at a scale that almost never happens. And Sarah's choice wasn't actually irrational. If Daniel had put that $50,000 into a coin that collapsed to zero, which has happened to thousands of cryptocurrencies since 2015, Sarah would be the one everyone praised at Thanksgiving. Her strategy, guaranteed preservation of capital with modest growth, is the correct default for money you can't afford to lose. Not everyone can emotionally or financially survive an 80% drawdown, and pretending otherwise is how people end up panic selling at the exact wrong moment and losing real money instead of paper money. Here's what nobody puts in the headline. Daniel's outcome isn't a replicable strategy. It's a single historical data point with an astronomical outlier result. The real lesson from Sarah and Daniel isn't buy Bitcoin or keep your money safe. It's that risk and reward are mathematically linked, and most people only want to talk about one side of that equation depending on how the story ends. Sarah and Daniel both thought they were making the responsible choice with money they never expected to receive. Daniel thought he was taking a calculated risk. Sarah thought she was protecting what she had. Neither of them could have known in January 2015 how this would actually play out, and that's the part the thumbnail never tells you. The real trap isn't choosing safety and it isn't choosing risk. It's looking at an outcome that already happened and assuming you'd have had the stomach to hold through an 80% crash, twice, without knowing how the story ends. And if you're wondering what happens when you take a smaller, smarter slice of your portfolio and put it into something volatile instead of betting the entire inheritance, that's a completely different conversation, and the math changes in a way most people don't expect. But for now, the next time you see a chart showing what $50,000 would be worth today, ask yourself one question. Would you have actually held on when it dropped 80%? Because that answer, not the chart, is the only one that matters.